So we've talked about a couple of different things in terms of these charitable trusts. I want you to stop that thought process right now of you giving it to the trust, income for your lifetime, and then ultimately a gift to charity. I want you to stop that process for a second and think of this process. Asset, income to charity for a period of time, remainder to family. Stay with me now. Asset, we can use the same thing here. This is what we're talking about now. We're on this, don't worry about what it's called. Same concept, all right? We got the asset being transferred in the middle here. Now, the function of this trust is to provide income to charity for a period of time. And when that's done, whatever is left in that trust gets distributed to children.
Jacqueline Onassis Kennedy did that.
Right. Why? Why in the world do something like that? Well, with this family that I was talking about, this fits very well because the children are pretty well taken care of. Grandchildren are an issue. When I say an issue, grandmom and grandpop would like to be able to do something for the grandchildren. Because what happens in this scenario, again, it's all a matter of taxes. It's a matter of transfer of wealth. When this happens, the IRS says, well, wait a second. You just made two gifts. You've made a gift of income to charity, and then you've given the remainder over here to your family. And what they do is they figure out the tax today. Now, I'm not going to get into all the details, but if you do it right, you can say that the value of the gift to charity is pretty much the same value as what you're giving because of the payout rate and the length of time. So it's conceptual that we can zero out the value of the gift to the children. So there's no taxes to be paid. But let's assume for a moment that you had to pay $1 million of tax. And let's just assume here that instead of $500,000, we had $5 million of, say, a business concern. And we expect that business to be around for 15 or 20 years. We also expect it to go up in value. And what happens is that if this thing goes up from, say, $5 million to 10, 20, $30 million, it goes to the heirs, income, gift, and estate tax free. Leveraging wealth transfer. When you're talking about people that are in that zone of having an estate well over $10 million, if you're under $10 million, pretty well, you can zero out your taxes because it's 5-5, okay? But for those people who are in that arena, and I don't know whether any, because I have ceased to try to look at people and say, oh, I've been fooled too many times. But for those people, this type of planning is incredibly, incredibly powerful as far as transferring wealth. And what we often see is that we'll combine this type of a trust and the charitable remainder trust. And so what you see here is you see a nice merging, if you will, of providing income for children, maybe grandchildren, and then lump sum distributions 10, 15 years down the road. And the end result is, getting back to that thing that we talked about before, they have choices of either taking family, government, or charity. And when you use these charitable tools, you have such a tremendous magnification of the wealth that is transferred, not only to the heirs, but to organizations that are deserving of support. So you got the last
couple more minutes on this, but what I wanted to chat with you about is that we're talking about charity like St. Joe's or the UK Foundation, some established charity. You could establish your own charity. How do you establish your own charity? Well, you could be a Warren Buffett or Bill Gates and set up your own private foundation. Why do they do that? Why do you think people set up their own private foundation? Taxes.
Have a name.
Have a name. All good reasons. Kind of nice to have and say, hey, I have my own foundation. It's a lot of it is control. Remember, if if you give it to a charity, the charity controls those dollars. So the Bill Gates Family Foundation controls those dollars. So if you want specific things done with your money, then you can set up your own personal private foundation. There's a concept called donor advised funds, and it's through a community foundation. And it takes as little as $5,000. But it's exactly the same thing. You advise the community foundation as to how you want those charitable dollars spent. You can have that to $10,000, you can have that $20,000. So in the charitable gift annuity, you can literally fund your own charity. You can even point your children to the donor advised board to make recommendations as to how to spend those monies. It's a pretty amazing concept. So, and it doesn't take highfalutin amount of dollars. But you got to understand your goal. You know, what is your goal? What do you want to try to accomplish here? And then somebody can come in, give you alternatives, tell you about the cost. But, you know, when we start talking about giving money away, you know, what's the first thing somebody does? Go away. So, you know, but the thing of reality of it is you can't take it with you. So you have to understand the income tax rules, the IRD, income in respect to the decedent. And we're going to spend an hour and a half on this topic. But charitable, commercial annuities. When you pay your beneficiary out of a commercial annuity, they have to pay IRD, income taxes. If you give your beneficiaries your IRA, they have to pay income taxes. And many times between California and federal, it amounts to 35 to 40% to 50%. How long, on average, the average family here in the United States, how long do the beneficiaries take to spend your IRA?
Right away.
It's 18 months, no matter what the size. Which is kind of interesting because it's thought of as found money. You know, that you hadn't talked about it, nobody knows when you're going to die, nobody knows the amount that's going to be in there, and you can get at it, whoever's named the beneficiary can get at that money within 40 days after death, just by showing the driver's license. So a lot of times, those kinds of assets are spent rather quickly. A charitable gift annuity, if you have, let's say, someone who may need income over their life, you don't want them to have immediate those dollars, you can put a charitable gift annuity as the beneficiary of an IRA account after death, not during life. Does it cost anything? No. Does it require an attorney? No. You could say in the charitable, in your IRA or 401k, I want to benefit St. Joe's. I would go up before I died to St. Joe's and I would talk to Jim and I said, Jim, what I'd like to do is when my son or daughter reach 60 or 65, whatever age you want, I want you, St. Joe's, to issue them a gift annuity. Can we do a memorandum of understanding in the file so once the money is received by St. Joe's that you'll issue that gift annuity?
Yep.
And Jim will say yes. Not Joe, Jim. But it's so simple. It doesn't cost anything. And now, instead of paying 50% in income taxes, 100% of the principal is earning that interest. So it may even turn out to be more financially beneficial to the individual versus getting it outright. The other thing I wanted to, one more minute, please hold on with me. We said practical. issues on a CGA. Let's say my goal is just to save taxes. Philanthropy plays a very minor role. Be nice to benefit a charity, but I don't really care. Common occurrence. If you want to increase income, sometimes the best rates are at a charitable gift annuity, and you feel good about the fact that it ends up in the charity after you're gone. Reverse mortgages. I'd rather have it go to a charity than I would a mortgage company like Wells Fargo.
Yeah.
If you got Warren Buffett stock, doesn't pay any income. Man, you can turn a Warren Buffett stock into income, no cost, get income tax deduction. If you sell income property, we did this for another individual who had $20,000 coming out of 2 properties, and he was tired of tenants and toilets. He didn't want to deal with another tenant again the rest of his life. But he didn't want to give up that $20,000. And he wanted $200,000 in cash, bargain sale, in his pocket. So we put 20% in his name, 80% of the property in the charitable trust name. When the property was sold, $200,000 went to him, $800,000 went into the charitable remainder trust. It generated over $18,000 worth of income, and now I get postcards from him 5 times a year from everywhere in the world. I'm serious.
Now, another, just to add to that, the income tax deduction that was generated by the charitable component eliminated the tax that he paid on the part that he sold. You stay with me on that? It's very important, because what happens is that people can walk away with cash in their hand, tax-free.
And the last thing is, some beneficiaries just can't handle a lump sum. I mean, there are some families, and first of all, in every family, whether it's in the immediate, the grandparent, or the cousin, there is someone who cannot handle money.
Yeah.
And it's a great way to do a charitable gift annuity, providing them a stream of income over their life, and they can never touch the principal. Anyway, Jim,
Hey, thank you. Thank you for the opportunity. My pleasure. My pleasure.
Like you said, this class could go on for 3 hours.
Yeah.
We don't have 3 hours. You don't have 3 hours. I know Bloody Marys are in the offing.
We're in on Fridays.
Thanks for being here. See you next week.